about a sector where investors have a love-hate relationship. There are many people who've made a lot of money out of real estate in this country, and there are many people who've lost their shirt because of real estate. What makes you a winner in real estate investment, and what are the things that you should be keeping in mind? That's what we're going to talk about. Let's talk about the Indian real estate market. And here, Sunil, let me begin with you. The Indian real estate market was an investor's paradise till about 2.5 years ago. It was primarily if you look at the residential market, it was primarily geared towards making investors rich. But somewhere along the line, what we forgot was unless there's an end user at the end of the cycle, the investor doesn't continue to make money. And that's what happened with the residential. Sunil, over to you.
Thanks, Sophie. So real estate, as we know, is going through a difficult phase over the last decade. It still remains a very important sector for the economy, and which is also witnessed with the amount of private equity we have seen this year, which is over 5 billion. So this sector, of course, remains very, very critical for multiple reasons. Unfortunately, I would say residential real estate has gone through the largest amount of pain, where it used to be an investor's market, which is now moving towards the end user market with the push government has on the affordable housing and the ultimate need of having housing for all. On the other hand, maybe commercial is still doing better. There's a lot more traction from global investors, a lot more money coming in the investor space in the commercial side. There are other alternatives which have opened up, like logistics, co-working space. Rental housing is yet to pick up in India. So I would still see that this sector is going to be very, very critical for the country, but maybe some segments, of course, are definitely going to face a difficult time for the next few years.
So Raj, what kind of returns can we expect from real estate, given that there are multiple asset categories within real estate itself? You've got residential, you've got commercial, you've got co-working spaces, logistics is coming up in a big way. So what are the opportunities here for the investor?
Sure. So if you largely see real estate in India, I mean, 80% of real estate is actually residential, right? That's the largest piece basically in real estate in the country. People tend to focus only on demand and supply basically from a evaluation of returns perspective. But I think what we forget is basically also the supply of capital in a particular asset class also to an extent determines basically what the returns one can enjoy. So what has happened over the last few years, basically 5 to 6 years in residential, is that though in 2012-13 the demand and supply kind of equations were fine, a lot of supply of capital, in the sense a lot of money basically kind of chose to follow residential, and kind of oversupply of capital, which led to oversupply of products, inventory, which started building out basically in 2015. Which basically we are seeing now, basically, which has created that inventory overhang right now in most of the cities. So of course now, obviously, even on the demand side, like Sunil mentioned, the investor variety is kind of almost vanished basically out of this sector, and it's largely now an end user market. So traditionally, basically, the returns that we had seen, say post the GFC in 2009, 2010, we as a fund basically were able to make even in early 20s from a senior secured position, debt position, which now obviously has come down to somewhere in the mid-teens. And in fact, the risk has only increased. So, and also when you see not just from an investor's perspective, even from a developer's perspective, the margin, the inherent margin basically in a project, in any residential project, has come down significantly because of increasing cost in terms of construction, approvals, regulatory compliances. Those have added basically to the overall cost and reduced margin. So all stakeholders basically in this particular asset class have kind of suffered. Today, when you take a development risk, you can try and aim to reach about 15 to 18% kind of returns. But for a HNI investor who's just buying a unit of flat basically kind of thing, we see. So the yields obviously are far lower at about 1.5 to 2%, and appreciation is something that we've not seen for a large period of time now. So clearly, I think that's something from an investment perspective is currently avoidable from a residential perspective. But the other asset classes, for example, office or retail. Office obviously is doing quite well in the country across cities. especially IT. We've seen enough leasing basically happening over a few years, almost 30, 35 million square feet continuously happening over the last few years. And like I mentioned, not enough capital actually has chased this particular asset class, and hence there's not enough supply, so to say, basically right now in the market. So when you see vacancy levels in most of the cities, Pune, Hyderabad, Bangalore, they're about single digit, less than 5% kind of vacancies, which obviously gives that benefit to the landlord or to the investor to price and increase its rental basically year on year. So, a commercial real estate, of course, can give better returns in today's scenario. The yields, of course, are higher than residential. They're about 7 to 9%. And with some amount of appreciation growth, basically, you can probably target 12%, 13% on a levered basis.
Akash, when people don't have favorable conditions within the Indian market, they have been looking overseas. Uh, what kind of investments have we seen in the overseas markets from Indian HNIs?
Well, primarily, we as Sadhvi Financial Realty only deal with residential. So our clients are looking for residential investments overseas.
And which are the markets where they're investing?
The popular destinations, this all depends on actually the requirement, whether it is for for self-use, for a holiday home, for the children's education, for immigration purposes. So the flow of inquiries would depend on that. But the popular destinations would be London, New York, Seattle, Singapore, Dubai, and now lately we've seen a lot of people traveling to Europe. So Portugal has become a popular destination. So is Spain and south of France and Italy.
And what is the volume of investment that is made when you buy overseas?
Well, it depends on how much you can send through LRS, unless you're buying through a company route or you have funds overseas already, or you already hold an asset that you flipped with certain gains and picking up.
How many investors are there for the long term? And normally, how long should an investor be invested in the to get good?
Well, if you ask me, for always, because of the fact that it mitigates your currency risk. Because once you invest in a currency that's either USD or a pound or maybe a dirham, which is pegged to a dollar, that makes a lot of sense with our rupee depreciating every year. Firstly. Secondly, it also varies in terms of the kind of rental yields that you may be looking at, because if someone's invested for rental. So if you're enjoying that, for example, if you invest in Dubai, your rental yields can be in downtown about 7%, which are tax free. So why not enjoy that and have a currency pegged to the USD forever? Right? If you were otherwise looking at something in London, if someone's taking something off plan, it's about 18 months cycle from the start of the development to the handover. And being developed markets, these are not delayed. They come on time. And and there, of course, you hold on to your investment after those 2 years for the next few years, these 5, 6 years, to see it appreciate.
And after that, you exit that, invest again, or you continue remaining invested in the same asset?
See, it really depends on the reason why you've invested, right? So if it is to be able to get a good yield, rental yield, then 7% is not bad at all. And if it hasn't fallen, you'll continue with that, and there will be a capital appreciation on your property. If you invested for currency diversification, that is something that is also forever, right? Also geographical diversification, reducing the geopolitical risk that there may be. So, there are a lot of factors that it's very specific. Actually, they say that, well, I've heard that you only sell real estate when you need the money. So if you don't need it and you're getting a good rental yield or capital appreciation, why would you?
Real estate is an asset that is not liquid. It is an investment that you have to hold, that you have to understand, and you have to be able to have entry and exit strategies. Another problem that with the Indian investor is that when you buy a piece of real estate, you start getting emotionally attached to that piece of real estate. And the minute the emotion is involved, you're not an investor. You can't exit a investment that you're emotionally attached to. And a lot of investors have faced that. They've missed the market cycle, not been able to flip because They held on to that asset for a longer period of time. Of course, there is another way of investing in real estate, and that is REITs. In the Indian market, it still hasn't. The first REIT is just preparing to list. But the point is, Sundar, talk about REITs as an investment option for the real estate investor.
Sure. So, I mean, if you look at REITs, I mean, as you rightly said, I mean, these are effectively an indirect exposure to underlying real estate in a liquid form with transparent disclosures, good cash flows, and reasonable yields upfront. So, as you said, if someone has an interest in taking exposure into real estate, entry, exit, liquidity becomes much easier. The levels of disclosure becomes easier. And you have someone else who sort of manages the asset for you, and you're sort of riding with the asset. So these are some of the benefits, which is largely one of the reasons why this asset class has sort of gained popularity in most global markets. If you look at from a global perspective, you would find there are the share of REITs as a percentage of the total real estate listed in most markets would be higher than 50%. So this REITs become the largest share of listed real estate exposure. The second part of it is, as an asset class itself, most institutional investors are trying to have a fairly sizable allocation to this asset class. So you look at most of the sovereigns, pension funds, etc. Most of them are trying to look at the amount of capital allocated to space. So this intrinsically is a reasonable asset class to sort of invest in. And as long as you have an opportunity to sort of invest into a liquid asset or a liquid paper with an exposure to this asset with good amount of disclosure and without the day-to-day headaches of actually managing this asset on your own, it becomes an interesting asset class. And the way the regulations in India have evolved, I mean, the regulations in India today are on par with what you would have in most other markets. And you have, as Raj was pointing out earlier, some of the assets in India are best in class. So this in our view, is going to be an interesting opportunity for people to play into this asset class, which always has been close to a lot of people.
Do you see people holding back with REITs? It is a new investment category, and like we said, it's only starting off in the Indian market. Have they experimented with investing in REITs in the overseas market? The investors, the Indian investors.
So yes, I mean over the the past 10 odd years, there have been companies with underlying assets in India which have gone overseas. And the fact was that we didn't have a framework for REITs to get listed in India. So in the absence of that, people tried to look at other venues, which is what happened. But as we said, I mean, SEBI has been sort of very forthcoming, and they've been trying to encourage more companies to sort of list in the domestic markets, which we think is the right strategy as well. I mean, in most other countries, you would see REITs listed with assets in the home country. So from that perspective, yes, I mean, this is the right step. Can it happen in overseas markets? I think that could be there. But I mean, if you have a home market with a large pool of investors who are keen to deploy in this asset class, there's no reason why. I mean, we shouldn't have a large market for REITs in India.
The REITs which are being planned today are largely planned for commercial real estate. We have spoken on the panel that 70% of our real estate development is in the residential sector, which yields only 1 to 2% at most. Do you see commercial assets being the only category where REITs will operate in India, or do you think that at some stage there should be a residential option as well, despite the fact that we have very low returns? The sheer volume.
Yeah, so I mean, our view is, I mean, it will evolve into the broader sectors. I mean, commercial seems to be the most popular. That's seen the most amount of capital from the private space as well. But there's nothing which stops retail or logistics, store, warehouse, or any of the other asset classes to sort of come to the market. And I think that's a natural progression that should happen. Residential, I mean, we'll have to still wait and see. I mean, I think the first is how evolved and how deep is the residential rental market. So, I mean, inherently, these are rental assets which need to be sort of housed within the REITs. So you need to have a thriving rental market, and then you need to have yields and returns which sort of make sense for the investors. So it seems that you would see maybe commercial, retail, maybe logistics, etc., as the first set of few. Residential is probably still some time away.
We've seen that the real estate investor in the Indian markets has more or less is lying low. You don't see a lot of investment happening, and some have burnt their fingers. Some can see that the market cycle is down, and it has remained down for a while now. Sunil, do you see the return of the real estate investor, and if so, how soon, and where will that investor be? Yeah.
So I think we've spoken about the different asset classes, right? So barring the residential, the other asset classes are outperforming. I think that we've already called out. Right? So residential, of course, is a difficult market, and it's dependent on many factors in terms of demand from the end consumers as well. Looks like maybe in the next 1 or 2 years the segment should be stable. Maybe it may take some time to give you the returns which we used to expect maybe 10 years back. It's a slow and steady cycle and needs a lot of patience, I would say. The next 3 to 5 years is something we should be hoping that the return comes to the level it used to be earlier.
So the investor will lie low for another 2-3 years, you think?
Seems like.
Do you think there are policy-wise we are sorted as far as real estate investment goes, or you would like to see some changes in policy as well?
See, in the residential, I believe there has been so many changes in the last 2 years, be it RERA, GST, demonetization. So maybe the system is getting cleaned, if you say so. That way, we are heading towards the right model of operating in a structured real estate environment. And I think we've been talking about rental housing from REIT perspective. So that segment in particular has not drawn interest from the investors community because of the lower yield and of course the way market has been operating. So I would say maybe in the next 2-3 years, the way policies have been drafted, the impact of this, of course, will change the perception of the sector, and eventually the investor class will also change into the other segments.
Raj, today one of the biggest problems in the real estate sector is where will the money come from? We need a lot of money. Money has been mismanaged, badly managed, or not managed at all. But we do see that capital is a big problem. Banks' exposures are very high. Fund exposures are high, and you are seeing a lot of crisis with the NBFCs as well. Where will the funds for this kind of real estate development come from? And is the bringing back the investor imperative?
So again, if you go back, about 12 to 13 years back, so maybe 2005, 2006, when the sector was actually opened up, we saw a good amount of inflows from foreign institutional investors, foreign funds, pension funds, fund of funds across the globe, investing into this country from an equity perspective. Obviously, everyone hoped that they will make a good amount of returns. The entire India story was too good to believe, kind of thing. But whatever happened, maybe GFC and others, basically, they've obviously kind of burned their fingers. Whoever came in early part of the 2005, 2006. What happened after that basically is largely the entire foreign capital stayed away from our country, and whatever that came in 2012, 2013 onwards has largely changed only completed asset strategy. So the money has not really gone for development, taking development risk, whether it is residential or office, retail, whichever asset class. And so post GFC, largely the domestic financial institutions, NBFCs, banks, funds like us, we've all kind of given money out as debt to this sector. I think that's largely been the problem right now because there's too little equity which is there in the system. The entire sector basically is kind of over leveraged. This kind of leverage is probably not sustainable in the long term, and therefore the country and the sector needs more of equity capital, flexible capital. So that's the need of the hour right now, and if it's not that the fundamentals of the sector have like completely shaken, but if you have flexible capital, if you kind of focus on the project dynamics before your own interest, I guess there is a way to basically kind of move this sector out from here. So we need, obviously, the need of the hour is to have more equity and more flexible capital, not just in the form of debt, maybe more structured, maybe more equity, that capital which is taking development risk. which I'm sure basically as the sector matures, as the country matures, as the rules because, RERA, for example, is a big booster basically for investors like us. It sets discipline in the sector. It will enable consolidation. Only serious players now basically are looking to continue playing out this market. All of this, I'm sure, basically will help gain investors' confidence, and hopefully we'll see more equity capitals flowing into this economy, basically in residential and other asset classes from a development perspective.
Akash, the kind of people who have stopped investing in the Indian market, what volume has started picking up overseas investments? Is it only for personal reasons, or is it actually the returns that they would need?
As I said a little earlier, the reasons to invest in the international market are quite varied. A lot of people are doing it, for example, for their children's education. So when they go overseas, they have a home to stay. Some people are doing it for diversification of the currency. Uh, some people are doing it for a second home for themselves. So this is something that has continued, and I've just seen that in the last few years, the trends are changing in terms of the fact that people are more aware of currency diversification and diversifying the geographically, their assets geographically. So that's something that has picked up.
At this point, I'm going to go to the audience. This is a sector that's very new as an investment category. And if there are any queries that we have in the audience, maybe we could pick those as well.
Hi, this is Vishal from Kindus Advisors. I want to know about the retail investors who were basically salaried or were investing in residential just for the tax saving purpose or something like that. They are almost gone now. So, what do you think? Like, when will that kind of investors be back in the market? And other than that, there was a category B which was purely investing just to park their cash in the market, the kind of the parallel economy, which is again now again the cash economy has started generating the money. So these two kind of investors, are they coming back, or like when are they expected to be in the market?
So I think we've already spoken. The residential market, especially, has been operating more on the returns, like you talked about, right? The kind of returns people were getting is maybe more than 20%, 30%, and these days are of course gone. So the residential yield, is, of course, is not lucrative enough for people to invest. The larger focus, if you see right now, has been on providing houses to the end users, right? So there's not much action happening in terms of the investments. Even the product class, if you see, is largely the affordable segment, which is really sustaining the sector as of now. And that's what looks like for the next 2-3 years, I would say. The kind of returns we used to get maybe in early days, maybe in the last 5 years, 10 years, is something which again might take 3 to 4 years once this cycle again improves in terms of the normal investors or people beyond the affordable category or the end users. So I would say the time horizon again can be 3 to 4 years to get that level of return.
Again, just to add to it, I think the transaction cost, in buying a real estate, that are now so prohibitive in the sense when you add GST and stamp duty, in most states, basically you'll end up, spending about closer to 16 to 18% kind of thing as transaction cost. So even if you were to buy under construction property, hold it for 3 to 4 years, to see it completed, and then when you were to sell it, even if you have a 5% appreciation year on year on the price, the transaction cost itself basically will negate that appreciation. So, right now, basically, we're not seeing double-digit appreciation in residential asset class, and hence, basically, for a investment perspective, unless you're buying a ready house where GST is at least not applicable, you're just paying stamp duty. It really doesn't make sense right now.
In fact, our research shows that about 84%, we ran a poll on Magic Bricks and we found about 84% of people said that they will buy only completed houses, not under construction houses. Two reasons. One is that the risk of delay is the developers and not yours. And therefore, the trust factor is very important. The second thing is that GST is not applicable on completed houses. And that has completely swung the market. The assets have to be built before the consumer buys it, or the developer has to absorb the GST values. And that is one reason why you see the inventory overhangs coming down, because as the projects get completed, and they haven't been completed, they are, in the northern markets, they are 5 to even up to 10 years late. But if it is completed, the consumer is willing to buy, because one, he's an end consumer, does not want to pay GST, and also does not want to take the risk of delays. When you talked about the investment in real estate, in the last 5 years, what has happened is that the consumer has come in, and the investor came in. He was the first buyer, and paid, intended to pay only 10% of the cost. Did not intend to pay more than that. After that, the first investor exited the market with whatever leverage value he got. The second investor came, the third investor came, and our study shows that the end user who came in was the fifth or the sixth buyer. So he has paid for the greed of 5 investors to pay off 5 investors, and then he comes in. And even then, the buyers were buying. The reason why the market tanked was that the investors then got greedy and colluded with developers and said, don't complete the asset, I want more. And when the asset never reached the end consumer, at least 20-30% of the buyers were end consumers. When they stopped getting their houses, that's when the real estate market tanked, and the consumer said, I'm not buying. And that's where RERA came in, that's where the government stepped in. When the end buyer says, I'm not buying, that's when a market is in a crisis. No investor can make money unless there is a final delivery that happens. At the same time, you should also remember that real estate, while that is the asset that's happening, there is also the support infrastructure that has to come. Roads, power, water, drainage, sewerage, everything has to come. When that doesn't happen, the asset value that you should have got as an investor. When you were an investor and you were trading in purchase, more or less, you didn't care whether all this came. But if you were a serious investor, and the kind of investors you said who should remain in the market, for them, the whole package is what enhances the value of the real estate. When that does not happen, the asset itself loses in value. And like Raj said, the transaction cost, if you charge a 12% GST, after that, if there is a stamp duty, the consumers are protesting. They don't want to pay GST plus stamp duty plus registration charges plus. And that's one reason why the investors have not come. Investors who are for long-term investors, 5-6 year investors, they will get the asset. But that asset, when you get the asset, there are so many more charges that come into it, and that makes real estate an attractive investment option today. But that doesn't mean that real estate is not coming back as an investment option. I think today governments, finance people are looking at options, and I think they need funds so desperately that all kinds of options are being explored. Anybody wants to add to that?
Yeah. All the reasons why you say it's unattractive here is very attractive overseas.
I have a question.
I think we have a question there, then I come to you.
This is Jay Toshniwal from Toshniwal Equities.
Yeah.
My question stems from one of the remark here that the yield in residential assets is about 1.5% to 2%. Across India is about under 3%. And someone said that probably it will take a few years for the yields to improve to compare with the commercial levels. The yields will improve by rising of rentals, keeping affordability in mind, or it will come up by falling capital values. That is one point. And second point is that the private equity returns from 21 to 24% has come down to about 15-18%. If the capital values were to fall, then where do the private equity go?
So I guess residential rental yields, right? I mean, so your question was whether capital values will fall or rental yields will increase. I think it's more about also changing Indian, psychology of being comfortable basically in staying in a rented house. I think most Indians basically love to own a house and then stay in that. It's not very, maybe it's in the culture, maybe it's in the, it's a family thing. But people generally tend to avoid staying in rental, and it's maybe it's a taboo or whatever it is. But we generally don't have a habit of staying on a rental place. So I think that needs to, if and when basically that kind of demand basically comes in, where people are more and more willing to kind of stay in rental houses, the demand for rental housing will go up, which will actually push the rental rents of a particular apartment. In terms of capital value, basically, it is also a factor of what the supply and demand is for the end product. And as we see it right now, basically, maybe there will be some amount of correction which will come in the prices. Again, pockets of various micro cities. It's not a generic thing. But largely, I think the yields will move up only once the trend of people actually moving into rental housing starts. So it's obviously going to be a combination of both. Capital values, I think, to a lesser extent, but I think more demand basically for rental housing is what will push the yields, so to say. And your second question was with regards to private equity making.
Yeah, the returns are already come down, and if the capital values were to come down, the returns may come down further.
Okay. So when we at private equity, when we invest, money, yeah, of course, I mean, the end product prices obviously determine our returns. But when we underwrite with certain assumptions, and essentially, basically, also depends on what your entry value, what your land cost and other costs basically of the project is. So even with moderate assumptions on growth, it is possible to kind of earn those kind of mid-teens to late teens kind of return that I mentioned on a more structured basis. So it all depends on the margin of the project, from a private equity fund perspective. Unlike a fund, basically HNI investors typically don't invest in land and projects. So they are completely dependent on the growth of the end product basically. So it's not just profit basically of the project, but it's more about the end prices. For us, it's also about margins and how the cost basically have changed. So if we enter in at at levels of land cost or construction basically which are comfortable, we are still able to make those kind of returns even with moderate assumptions of growth.
Hi, my name is Amit Jain. My question is, if I'm looking for an investment, should I get into a hardcore real estate, residential 1, commercial 2, or I should get into a real estate structure products from an investment perspective? What is your view?
I mean, at the end of the day, I think it's a question of risk appetite of each investor, right? I mean, you look at it as a fund, as an investor, Raj, I mean, he would be investing across all the asset classes. And the way he would sort of solve for it is he would have different return thresholds for each of the asset classes, right? If you sort of look at it across the risk spectrum, a completed commercial asset is probably the lowest in terms of the risk spectrum. So if you're looking to solve for reasonable returns with relatively low risk, that's probably what comes in. And then you sort of move forward, you move to the structured side of products, which is there is some sort of underlying security against your cash flows which you're looking for. And then ultimately is where you have that development risk which is there. So you move along the risk spectrum, the returns are also expected to sort of vary. And ultimately it's a question of where in the risk profile would you like to play and what is your risk profile. It's a little bit like investing between debt and equities, right? I mean, both have their own characteristics, right? Real estate, yes, these are all equity products, but at different levels of return and risk.
Just wanted to close with one statement that the residential return of 1 to 1.5% that we are talking about is because most of the development that we have been assessing is in the peripheral areas of cities. Suburban returns have not matched core city returns, and core city returns is investment was something that our investors were not looking at. The minute we see a more well-informed investor who starts studying the returns, core city, suburban and peripheral returns, that's when you will see a more engaged investor coming into the real estate market. Thank you so much. Thank you for joining us in the panel.